Welcome back, CTA and SAICA students. Let's get right into it. Today, we're tackling a highly structured explainer on paragraphs J, K, L, M, and N of the gross income definition under the South African Income Tax Act. We're going to break down these complex provisions, look at some original, exam-focused examples, and make absolutely sure you know how to secure those crucial marks in your board exams. Here's our roadmap for this explainer. We're moving logically from macro theory, looking at the framework and asset disposals, straight through dividends, insurance policies, and recoupments. Then we wrap up with crucial exam techniques, an integrated master scenario, and a final revision checklist. All right, part 1, framework and asset disposals. So where do these specific inclusions actually fit? This is your standard normal tax payable framework. We care about special inclusions because they literally override the general rules. Think about it. Even if an amount is purely capital in nature, which would normally disqualify it, if it gets caught in the net of paragraphs A through N, boom, it's pulled right back into step 1, gross income. Let's dive right into paragraph JA, dealing with the disposal of certain assets. The golden rule here? The full proceeds from selling a capital asset hit gross income if 2 very specific boxes are checked. First, you, the taxpayer, must have manufactured, produced, constructed, or assembled the asset yourself. Second, it has to be similar to trading stock you usually make for resale. Picture a car manufacturer. They pull a fresh car off the assembly line to use as a company demo vehicle. It's a capital asset now, right? But when they eventually sell it, those proceeds flow straight into gross income under paragraph JA. Now watch out, because examiners love this classic trap. The absolute key for JA is that the asset was created by the taxpayer, not just bought off the shelf. If our car manufacturer simply goes and buys a delivery truck from a totally different company, uses it, and then sells it, well, paragraph JA doesn't apply. They didn't make it. It stays purely capital in nature. Don't let them catch you out on that. Moving right along to section 2, dividends and insurance policies. Dividends are heavy hitters in any tax syllabus. Under paragraph K, all dividends, local and foreign, start out right here in gross income. But then it's like a fork in the road. Local dividends usually score an exemption later on under section 10(1) KKI. Foreign dividends, they face a whole maze of section 10B exemptions, and remember, you absolutely cannot deduct any expenditure incurred to produce them thanks to section 23Q. Oh, and REIT distributions? If you're a resident, those are included under paragraph K, but they are explicitly not exempt. They get taxed as ordinary income. Same goes for dividends received as part of an annuity. Now here is a massive exam tip. If you see a net dividend after 20% withholding tax, 80% is your magic number. You have to gross it back up for paragraph K. The Act demands the gross dividend in gross income. So if the scenario says R80,000 net landed in the taxpayer's bank account, you literally just divide that R80,000 by 80% or 0.8 to get your R100,000 gross inclusion. Easy marks if you remember it. Let's shift gears. Paragraph M, the famous keyman insurance clause. This specifically drags life insurance payouts right into an employer's gross income. But the hurdles are strict. The employer has to be the policyholder, and the policy must specifically cover the death, disability, or severe illness of an employee or director. If a company gets a massive payout because the top director tragically passes away, that whole lump sum hits their gross income under M. And just a quick aside, under section 23B5, the employer generally can't deduct those monthly premiums unless very strict employment-related conditions are met. Here is how you master the difference and save your marks. Always ask yourself, who is actually holding the cash at the end of the day? If the employer gets the payout to compensate for losing key staff, boom, paragraph M. But if that payout flows directly or indirectly to the employee or their family from an employer-owned policy, that's paragraph D2. Mix those up and you're throwing away marks. All right, section 3, recoupments and other inclusions. Think of paragraph N as the ultimate catch-all net. If another section of the Income Tax Act points at an amount and says, hey, this must be included in your income, paragraph N is the actual mechanism that drags it into the gross income definition. The absolute classic here is your section 84A recoupment. Say you bought a machine for 100,000 Rand, claimed 40,000 Rand in wear and tear, meaning your tax value is now 60,000, and then you sell it for 90,000 Rand. You've essentially recouped 30,000 Rand of those past allowances. That 30,000 Rand flows directly into gross income, courtesy of paragraph N. Section 4, crucial exam techniques. We've nailed the mechanics, now let's secure those board marks. Here are your golden rules. Seriously, never just write specific inclusion on your paper. 0 marks. You have to cite the exact letter. Write paragraph JA or paragraph K. Always scan the page for the word net next to a dividend and gross it up. Always check the source. Is it SA, foreign, or a REIT? For insurance, spot the receiver to choose between M and DDI, and for N, always tell the examiner which underlying section is pulling the strings, like Section 8.4. Okay, Section 5, Integrated Master Scenario. Let's put this all together. Time for some mastery with a 100% original integrated scenario. Let's look at X Limited, a car manufacturer. They sold a demo car they built themselves for $300,000. During the year, they also received an $80,000 net local dividend, a $40,000 foreign dividend, a $50,000 REIT distribution, and an $1 million insurance payout on a deceased director. Finally, they sold an old depreciated robot, triggering a $20,000 recoupment. While you read this over, try to mentally tag the correct paragraph for each transaction before I reveal the answer. Here's your perfect full-mark solution. That self-manufactured demo car, that's a paragraph J inclusion of $300,000. Look at the local dividend. The $80,000 net was flawlessly grossed up to $100,000 under paragraph K. The foreign and REIT dividends, also paragraph K inclusions. The $1 million insurance payout lands under paragraph M because the employer got the cash. And that $20,000 robot recoupment gets swept up by the paragraph N catch-all. If you systematically label every line item like this, you will absolutely crush it. Finally, Section 6, Final Revision Checklist. Let's lock this in. Quick, rapid-fire revision. Paragraph J is your go-to for assets manufactured by the taxpayer. Paragraph K demands gross dividends, no exceptions. Paragraph M is all about the employer receiving the insurance cash. Paragraph N is your catch-all for things like recoupments. And the ultimate golden rule? These specific inclusions forcefully override the general gross income definition, especially regarding capital receipts. If you can rattle these off, you are ready to dominate this section of your syllabus. And that brings us to the end of our explainer. But remember, forcing an amount into gross income is literally just step 1. The real fight is in the next step. How are you going to defend these amounts against the complex web of Section 110 exemptions? Think about how those local and REIT dividends behave next. Keep grinding, keep reviewing those frameworks, and I'll catch you in the next explainer.